invite Norbert, Mr. Braspanian, and Jiaxin from ING and BMG to discuss about liquidity management. So Norbert and Jiaxin, please.
Sure. Thank you very much, Jan. And as Jiaxin is preparing the slides, let me quickly introduce myself. My name is Norbert. I work for Amsterdam-based subsidiary of ING Bank. ING, obviously, also a Dutch bank. And the business unit I work for, BMG, is specifically specialized in dealing with liquidity management. Unlike the IPR SME help desk, our services are not free of charge, but I would guess you would know as much, though we are fast and confidential as well. And Matthias mentioned in his slides that during webcast you should refrain from sharing confidential information. Well, all the information that we are about to share with you is not confidential. It's part of our marketing presentation as well. I'm myself responsible for sales and marketing in Asia, which includes also obviously Japan and Korea and India as main hubs besides China. And I'm supported by one of my team members, Jiaxin. Jiaxin, would you like to introduce yourself already at this moment?
Sure. Thank you, Yang, for inviting me to join the webinar. I'm Jiaxin, and I'm responsible for sales and marketing activities for BMG in Greater China, and currently that I'm based in Hong Kong. So please feel free to ask questions during the presentation or later in the Q&A sessions, or contact us in later moment.
Okay. Well, Jiaxin, if you would be so kind as to take us to slide number 3. I've been asked to share some insights on the current situation the world is actually in, and of course I'm going to try to put that in the perspective of corporate treasury. Well, the fact that the role of corporate treasury evolves over time is really nothing new, right? Technology, business requirements, and the economy in general are textbook drivers of evolution in corporate treasury. But regardless of these drivers, several key functions and processes that corporate treasury focuses on will always remain. And the fundamental task of a corporate treasury is obviously to ensure a company's financial health. Examples of instruments to carry out this task are cash management, foreign exchange, risk management, regulation, investment and funding, financial supply chain, and technology. If you would take us to the next slide, Jiaxin. The consequences of the corona pandemic have actually affected these instruments and put corporate treasury's fundamental task, right, ensuring the company's financial health, in a completely different perspective. The world's economic output will be significantly reduced as a result of a severe supply shock, which we saw earlier on, followed by a demand shock, as during times of economic downturn, eventually the public will simply spend much less. Potentially there will be several more waves when regions get reinfected as lockdown measures are relaxed, right? And travel between, for example, countries and continents is again permitted, or when the contagion returns this autumn or in spring next year. The importance of cash management is not to be understated. Cash is the lifeblood of any business, and that's why I emphasize the phrase cash is king. And by generating enough cash, a business can actually meet its everyday business needs and avoid taking on debt. This may seem really straightforward, but a lot of resources on the corporate side are put into ensuring that the right amount of cash is available at exactly the right time, in the right location geographically, and in the right currency. This sounds easy, but it's already difficult at the best of times, and it gets even more challenging during times like the present, during times of Corona. If you would take us to the next slide, right. So if taking on debt can be avoided by generating enough cash. So what happens if Corona makes generating cash very difficult or even impossible, right? Well, an obvious response would be to take on more debt, to take on more debt. However, a major impediment that we see currently is that the corporate debt market is likely to implode due to the shape it in. Another reaction is quite similar to what we saw the general public respond to, is actually hoard. In well, what we've seen, long supermarket queues, right? The general public was buying large quantities of canned food with a long shelf life, and obviously also toilet paper, in order to prepare for the bad times. Well, businesses are not really different, and also in preparation for bad times, they stockpile, but they stockpile on liquidity. So where empty shelves in the supermarkets illustrate a mismatch between supply and demand, similarly for businesses, liquidity dries up, right? And whenever that happens, whatever is available is priced through the roof. And then if we look at an isolated case on this slide versus a global negative shock, what I'm trying to say is, if in an isolated case, a business experiences a severe negative shock through no fault of its own, it will definitely be able to obtain financing in order to continue its business. But if most firms are suffering the same shock at the same time, and the outcome looks as uncertain as it currently does, there is a completely different story. Financing suddenly is not readily available. And why? Well, there are two main reasons. Firstly, that's the way the corporate debt markets react to the global shock. This is impeding businesses from accessing funding. And secondly, due to the fact that all counterparties of a business are suddenly affected, which means that the flow of cash for corporates will be severely impacted. It's not just one counterparty which is affected, all your counterparties are equally affected, which means that all your counterparties might get back to you to renegotiate payment terms, might decide to delay or not pay at all outstanding invoices. And regardless of not receiving your cash from your debtors, right, your accounts receivable, if you like, still you need to honor obligations to your creditors, your accounts payable. Well, let's look at both of those instances in a little bit more detail on the next slide. So the corporate debt markets reaction, right? During during times of financial crisis, financial institutions, commercial and risk appetite simply changes. Market risk is avoided, internal hurdles are up, and sanity checks the same are also up. And why? Well, lately, the rating agency have been downgrading corporate debt at a very rapid pace. So bank loans to businesses are simply considered riskier. Financial institutions are therefore less interested in granting loans. It's as simple as that. And that's even making things worse. And if you think that central banks can easily step in, which they try to do in order to provide low-cost funding, right? Well, recently introduced regulations, for example, Basel III and onwards, will definitely impede banks from making balance sheet available. Simply meeting capital maintenance ratio requirements is very costly for banks, and they will not just simply open the door to whoever needs funding simply because their cost of funding is relatively low. And especially if the rating agencies start to downgrade companies, it makes meeting those ratios for banks even more challenging. Well, as an insurance against companies defaulting on their debts, financial institutions can also use so-called credit default swaps, right, CDS. But strangely enough, or maybe even understandingly so, the pricing is back at the level it was immediately after the Lehman shock, right? So that's really not helping. Hence, the cost of borrowing for businesses considerably higher than before the crisis. And this will put a lot of extra pressure on the companies that are already struggling to cope. On the next slide, if we quickly look at some of the highlights, I will not spend a lot of time on this slide, right? We're facing a deep global recession. At least that's forecasted, right? The world's GDP will drop significantly. Sufficient stimulus packages announced, but will that be sufficient? Corporate debt, as I outlined, especially the corporate debt market, is in its own state of turmoil. And then we have certain sectors which are even harder hit than others. So the question to corporate treasury is actually, have you prepared for the winter, right? What can you do? What will you do? If we look at the next slide, if suddenly the inflow from, let's call that accounts receivable, is far less than forecasted, simply alternative sources need to be tapped into in order to continue to meet obligations. It's as simple as that. But there is an immediate need to borrow or to bridge the gap. It's not like, well, we can wait a few days or we can wait a week or a month. So what are the real options? And let's take a European subsidiary of an Asian headquartered multinational as an example. So the first thing the subsidiary can do is turn to its local bank to arrange a loan in euros. Well, in order to get immediate funding, this will not necessarily work because a loan will take at least a few days. And that's time usually those subsidiaries don't have. And to make matters worse, the local bank will probably not be eager to extend the loan. And if it does, it will do that at considerable cost. Okay, then the subsidiary may wish to utilize its uncommitted overdraft facility, which it had already acquired in the past, right? Well, regardless of the currently extreme high cost for uncommitted overdraft facility, the nature of the facility is uncommitted. And banks have the tendency to try to sell you an umbrella, but ask the umbrella back by the time it rains, right? Those banks might already have terminated unilaterally the uncommitted facility in light of the economic crisis. Furthermore, uncommitted overdraft facilities are usually aimed at bridging cash flow mismatch for a very limited time span, a few days at most. This cannot be relied upon in an extended period like a crisis. So what's left? Well, the subsidiary can turn to head office to request funding, right? And in my example, turn to Asia, assuming that either the head office has sufficient liquidity or it has adequate access to liquidity through one of its relationship banks. But the timing, again, here is probably of the essence, and a few bottlenecks emerge. Borrowing cost will, the borrowing itself will probably not be in euros. Turning to the Asia headquarters, there will be different currencies at play, which actually means that if let me close here a screensaver which switches on, which means that something we've seen during the time after the Lehman shock, as well as after the burst of some of the bubble economies, that in those circumstances, Asian banks will simply have difficulty sourcing foreign currency as themselves as well. Again, as a consequence, there will be additional premiums on foreign currencies, and those premiums will be paid on to clients. So what I'm trying to say is, borrowing from by a head office will not be in euros, and if it is, it will be extremely expensive. If the euros are in the case for the head office not accessible and available, Well, the borrowing might be in local currency, right? A Japanese headquartered company might be able to get its hands on Japanese yen through its relationship bank. But that will mean that those Japanese yen will need to be swapped into euros. That will take, again, additional time, and it also introduces foreign exchange exposure for the headquarters. And depending on the term of the exposure and the respective policies, this might even be potentially subject to hedging. Furthermore, if then those loans are extended into Europe, an intercompany lending administration needs to be maintained, cumbersome, intensive, lengthy process, and you need to make sure that you meet all kinds of requirements as arm's length and transfer pricing from that perspective. Leaving it up to you, Jiaxin.
Well, thank you. So I think in the following, my part will be only 8 pages. So I hope I can run the time on time.
You have plenty of time, Jiaxin. So good news is I have just extended our webinar time, so we have enough time to discuss liquidity management as well as any questions about IP protection.
Thank you,
Go
yeah.
ahead.
Okay. Anyway, I have 8 pages left so I will do it accordingly. And in the following, I will help you more dive into the liquidity management product and how to choose the solutions that fit for you. Different corporates will have the different needs and why there's a difference. As Norbert just said, that liquidity is very important, so you have to look into what will be matters to you. And he also introduced some manual ways to make transfer or funding to your local subsidiaries, which is, I think, is not really efficient experiences. So before maybe I talk about page 10, I would like to share a little bit my experiences back to 2008. When I was a freshwoman as a corporate treasurer with my old company. I think back to that time that liquidity market was severely hit, and even for big companies, it's hard to borrow in the market. And then the company that work, since that there's 19% revenue is in offshores, so they decided to make a decision. So let's look into the revenue offshores and let's do the manually centralization. So what we do, actually, we have 5 FTE in the team and we don't have many people on the ground. And we'll do this manually every day to log into different systems, to make phone calls to the subsidiaries, to check how much balance that you have, how much money I can transfer. So that's a really manual procedures that we do for centralize the cash at that time, because we don't have liquidity to be borrowed. So then the process is lousy, and I'm really doubtful about the work I've done, and I'm really puzzled about what career I make. Of course, short after that, I think the team was being introduced by a concept, and which you also see on here. Can you see that? So the chart, the pictures here. So you see that we called it's overlay global notional pool, which they follow the principle is that one system which can deal in a lot of currencies. So for example, as a BMG, take BMG for example, we're dealing with 35 currencies, and we offered multi-entities, regional, globally, a lot of regions, and also globally flexible, and there's no changing of the balance in the accounts and no intercompany loans. So that's really efficient, and also I think the treasurer can really enjoy by this kind of setup to centralize your cash by the end of the day, of that day. So either you invested or you funded the pool. You don't let your money sleeping in the accounts. So that's about the really concept that of the notional pool, or we called global overlay notional pool. And in the next page, I think that's some discussion or dialogue that I had with my clients. Normally, when they want to looking for the liquidity management solutions, they always firstly engage with their relationship bank. But be mindful, I think liquidity management is different from the cash bank. It doesn't simply using a reward mechanisms. So you have to talk with expertise in this field. So, and also in the later presentation, in the following pages, I will cover some aspect of set-off and Basel III and current total different set of interest rates in the pool. Maybe I can give you some the current situation here we have in the market. So the challenges. I think here, this page, we're trying to, seems very busy because there's a lot of lines here, but we're trying to tell that the challenges is that if you want to implement one standard system or platform or procedure to all of your subsidiaries, seems like task impossible. So you might face the challenges that you lack of visibility of your local cash, or you imbalance with your surplus cash towards your deficit needs in the different locations or different currencies. And especially that if you have newly acquired subsidiary, they're always resistant to cooperate. They're always resistant to embed with your one system. So the conclusion here is simple. You have to carefully assess your challenges, and maybe you have to find a light and speed implementation of solutions with the least disruptions of your local operations. So to achieve synergies between headquarters and among all your subsidiaries. Next page. Here I want to talk a little bit about BMG positions. So I'm not sure whether Norbert has mentioned that BMG is very unique here. We only provided liquidity management products. So in this field, 3 products that maybe run into your eyes. So on the left-hand side, we have cash pooling, and which is the most sexy product we provided to our clients, especially among the Chinese clients. The very well-known is the notional pool. We call the multi-entity, multi-currency notional pool. So very long name, but anyway, I will brief you later. And netting. Netting is a product which can really squeeze your liquidity when you have a lot of intercompany transactions. So you can outsource full your intercompany payable to BMG. So BMG can calculate and settle all your intercompany in one payments, which can mitigate a lot of your FX transactions and also your payment volume. So that's a way to squeeze or free up a lot of your cash. I think that's a very good tool for manufacturer company in particular. And lastly is more about info system. So as a corporate treasurer, you have to know where and when, and of course, which currencies that you need cash. So as such, you have very comprehensive system to let you to know. So in that regard, we have a system in that place for multinational corporates to deal with that. So that's how BMG's product. And in the next page, I want to talk a little about different favors. So if we're talking about pooling, basically that people knows that physical pooling or the notional pooling. And I want to do a more in detail. So we have actually here in this chart, I put in the 4 category, but actually it's the physical and also notional. So if you see the cash concentration, or we call it virtual cash management, is more like a physical original level. So that can be in 1 or 2 currencies, which is, I think, is typically very fit for the company which is in small size or medium size. And notional pool, which can be in the global way, or you can be in several regions. And some of the banks are providing in the regional level as well. So here is also dealing with much on the regional level. And on the top, we have overlay cash pool. that's actually is very fit for the multinational corporates. They have many of countries and many currencies, so they need to deal with them all in one system. So remember that picture in page 10 that you see all the currencies that interact, sweep in and sweep out is in one system, and that's how it works. And usually that for the physical pool is relatively implement actually not that bad. But if you are a multi-national corporates, you prefer to have the notional pool or one global pool. The one reason is that there will be the least impact to your subsidiary operations, and they will be also very quick implement and also have tax friendly. That's very important reason, and also saving a lot of cost as a disregard. I'll go around to the next page. So I think this is about some features about the notional pool. And if you're looking at the different banks' website, actually they are highlighting a lot of key characters of notional pool. So some takeaways is that, so first of all, it should be the full set off. And second, it should be the notional calculate of the overall pool balance. So you can calculate no matter in what currency, in what position, and you calculate the pool in one position. So that, but you have to calculate, not physical converting. And third is there's no FX conversion in this regard, it's true notional. And then I think here I quoted our article from Citi, and they say they are actually set up a pool in Netherlands, and everyone maybe know or may not know that Netherlands has a lot of tax treaties in regard of withholding tax. Yeah, it's top of the number countries. So that's the key characters. And I think if you combine this together, it's come to what BMG can offer. So we have emphasized many times that how the notional pool it should be, and which that in just now in just page, a previous page, that many banks has repeated the key features. So if you want to really examine whether the pool is notional, you have to combine all together. And here is the bank brochure that BMG is giving to the clients. So just for your reference to understand what is the key feature of the pooling. And in the next page, I think here is more very specific, but it's also kind of inside out, and give you a little bit from the bank perspective, why every bank's providing it so differently, or why can we all the banks provide the same product. So yeah, I think looking at the BMG model, we are so successful. We have more than 218 clients, and we only provided very selective products, but we have been so well known in this regard. Many banks probably can do that, but maybe not. So in this page, I just trying to explain a little bit about how the regulatory, how Basel III play in this regard. So if we have to looking at these pictures, we have to think about some assets or liability. All you see is that your debit balances and credit balances in the pool. So I deposit to you, or I using other entity to withdraw. So that's created deposit and debit position in the bank accounts, which created at the bank balance sheet is liability and assets, which if the bank treated it individually, that will be things that very costly, because the bank have to pay the capital in the gross amount. So very importantly is that Basel III is intended to not particular to cash pool product or notional pool product, but they doesn't allow the bank to offset their assets and liability to achieve a netted position. So which means that you have to pay the capitals on your gross risk-weighted assets, or you have to meet the liquidity coverage ratio by 100% by place the high liquid assets in this regard. So that will be very costly for bank to provide it. So as such, the bank has to find a way to link assets and liability together to achieve the set off, which I think in the market, every bank will find ways, and many banks will find different ways. So there will be changing to the different models. And if the bank can find ways, first of all, and second, they can find a most easiest ways with the least disruptions of the operation of the clients, and also with the least cost, and they will be success. And I think that's why BMG can provide it so cheaply and also so friendly. So lastly, I think that's my last page. Before I come to a conclusion, I think I want to highlight a little bit on the interest rate. So BMG is very unique because we talk about is that we are only the liquidity managed bank. We are not lending bank. So the interest rate that we see in the pool is very, very low. And if you compare that you borrowing from the market, because we don't borrowing, so BMG don't borrowing, but we actually we call swapping in the market, or we using one currency to get other currency. So actually we don't borrowing the market. That's why the interest rate is so low at this point with the pool accounts. Some of the clients will also argue that whether it's good or bad. I think good and bad is same time. Bad is maybe you don't enjoy as much as interest income as normal times, but good is that you still enjoyed operational excellence and efficiency and tax saving in many aspects. So I think that's you have to looking at in a holistic picture. I would like to quote a Chinese saying is that when it is snow, when it's very cold in the winter, no one give you the coat. So it is raining, no one give you the umbrella. So have to prepare it for now, and maybe let's act for now. Yeah, that's from my side.
Well, thank you very much, Norbert and Jiaxin, for your introduction and presentation on the liquidity management. I think all we know during the period of a crisis, the external situation is becoming very difficult, of course. If you want to borrow money at a difficult time, the banks will you'll find that it's not easy to borrow from the banks because they are tightening their credit. And when the time is easy, so the banks will go to you and sell their loans to you. So that's not unusual. So the best way is really to make the best use of your own liquidity. So now, after the excellent presentations on IP protection and liquidity management, I would like to invite our participants, if you have any questions